All right, there we go. And welcome everybody to Asoba's first webinar. We'll have these as monthly webinar series with different topics each time. And this first topic is around optimizing energy trading with real-time data. So as a way of introduction, my name is Shingai Samudzi. I'm the CEO and co-founder of Asoba. We have a focus and a mission to drive 100% electricity availability across the continent. Our starting point is in South Africa for many reasons. The primary reason being that it is the most advanced and developed electricity market, particularly on the private side on the continent. And I think it offers a lot of really good insights into what business models and what technology stacks can work in a more developed or evolved market approach. And these represent opportunities to then scale into other countries, whether they are across the SADC region or across Africa in general. So just as a quick overview of what we're going to cover today, there are kind of four key topics that I want to focus on. So the first is just an introduction to the energy trading inefficiencies that are the problem domain that we are looking to solve with our technology. Second is to then dive deeper into what those specific API capabilities are through our technology made available via API. Third is around how we integrate the API with either SCADA systems or other types of operational platforms, smart meters, smart controllers, et cetera, to streamline both the forecasting as well as the dispatch decisions. And then finally, we'll talk more about industry-specific use cases and then do a little bit of show and tell and a demo in terms of what things look like and how they work. So with that in mind, just a few housekeeping rules, although I think everybody's already observing these. I'm actually going to turn off my camera as well, just to save a little bit of bandwidth. But basically, just make sure that your camera and microphone are off. So camera off, microphone muted. Obviously, in Q&A, you can then unmute your microphone to ask any questions that you have. If you have any questions during the presentation, please feel free to throw them in the chat as well. I want to keep this session a bit interactive. So if you have something that you want me to can either go over or reiterate or anything like that, please feel free to throw it in the chat. I mean, we don't have a ton of attendees directly in person here, so I think it's going to be easy enough for us to do that and have as a bit more of a flowing conversation. And then after the presentation itself, we'll have a Q&A period. And again, that's meant to be very interactive. So, lots of back and forth questions, et cetera, are absolutely welcome. So with that in mind, as I said before, our mission is to ensure 100% electricity availability across Africa. And just to kind of dive into what that means to us specifically. So I see that as two specific elements when we say availability. So one is the power is always on. In other words, it's actually accessible. And then number two is it's affordable. In other words, it's not just there for people to use, but it's actually available to anybody who needs to use it. The reason why this is important to us, and we often get branded as a climate tech company, in part because anybody that works on clean tech or solar or anything like that is typically, at least in the United States, branded as a climate tech company. But the thing that we want to make very clear is that we see economic development and human quality of life as the primary goal. So we would say that we're more of an economic development company or a human quality of life company first. And the reason why we say that is the relationship between electricity availability and GDP per capita is fairly linear. When you look at the World Bank graph, where they chart most or every country in the world on those two axes, right, you see that there are no energy-rich poor countries. So what that means is essentially that electricity is the foundation for economic growth and economic activity. If you don't have electricity, you don't have universities. If you don't have electricity, you don't have hospitals. If you don't have electricity, you don't have schools, you don't have manufacturing, you don't have job creation, all of the core things that are essential for economic development, which translates into people being able to earn money and participate in the economy and therefore actually be active participants in democracy. It all hinges on the availability, in other words, the accessibility and the affordability of electricity. So that is the center of what our goal is and what drives us as a company. And so the specific vision of how we implement that is around optimizing essential public utilities, starting with electricity right now, to unlock these sustainable economic growth opportunities, both for Africa and the world. And we say the world here, even though we're an Africa-focused company, because at the end of our day, our technology is accessible to anybody in the world. And we do actually have clients that are not just in Africa, but in the United States as well. So I think that's just another key factor, is that the technology that we're creating is not something that is geographically constrained or specific to a given setting. So with that in mind, I want to talk also about the overview of the energy trading landscape. And again, we want to start with South Africa or Southern Africa as kind of our initial nexus, although a lot of these elements are going to be true regardless of where you go on the continent. And the 5 key elements that we look at, or the 5 key challenges that we look at, number one are high operational costs. From the standpoint of being an electricity generator, there are a lot of operational costs that you have to deal with, from the reinsurance perspective to the O&M perspective, to the fact that, you know, with an energy source that's non-dispatchable like solar, you also have to deal with the fact that it's not necessarily always available, and that means that you're going to have revenue loss. There's also the addition of delayed transactions. So the actual ability to execute a decision that you make in terms of dispatch is also going to be important. The latency between the decision and the actual action becomes an element that does end up costing you revenue. As an example, when you look at virtual power plant systems or electricity trading systems or markets in Europe, for example, you see that the trading frequency is often down to the 5 or 10 second interval. When you compare that to South Africa, right, where South Africa ostensibly has a time of use trading window, where realistically time of use still varies on an hour-to-hour basis. South Africa has a very clunky time of use sort of approach, where they're essentially trading windows that are multi-hour and sometimes, you know, entire days. So they're not really functionally time of use when you compare them to European or North American markets. So again, that makes a difference in terms of the speed of transaction that you need. That takes a little bit of pressure off of traders in the African context. But again, that also means that you are leaving a lot of money on the table if you're not able to provide either accuracy of forecasts or decisions at a sub-hourly or sub-30-minute type of interval. We want to move the market and position the market to be in a place where we can trade at much higher frequencies. That will allow energy traders, billing companies, et cetera, to be able to realize a greater share of the revenue that's based on the actual value that they're providing end users. There's also limited transparency, and this is limited transparency from the standpoint of customers in terms of what is going on behind their bill, and understanding what are the various cost drivers and cost components. Those are important because end users, particularly business users that have significant bills, also need to be able to understand how they can change their own behaviors to shift cost to certain times of day that are cheaper electricity, or that also just result in lower overall aggregate load within a system, right? So you talk about sort of demand shifting, and demand shifting is not something that is necessarily going to be implemented top down. It's typically something that's actually bottoms up, where end users or consumers are actually looking at their bills and making their own decisions about how they then consume going forward to reduce their own bills. Then you also have inaccurate forecasting that's leading to revenue losses. And this is probably one of the bigger pain points. So when we talk about forecasting, we're talking both about production forecasting. So the forecasting of your generation assets, the solar, the wind, whatever renewable assets that you have, as well as demand forecasting. So what is the load going to look like at an individual meter level or at an aggregate bulk meter perspective? Obviously, bulk meter forecasting is a bit more predictable or a bit easier to do than individual meter forecasting. However, if you're able to crack the nut, which we are in terms of individual meter forecasting, you're able to drive greater levels of revenue from the standpoint of the trader. And you're also able to drive greater levels of accuracy in terms of demand shifting, particularly peak demand shifting. So you're able to have more control on both sides when you do have much better forecasting. And then lastly, you have operational inefficiencies that are due to demand visibility issues. And this speaks more specifically to the ability to do demand forecasting and really understanding demand on an individual level. Because we also recognize that not every single energy trader is going to be trading using bulk meters. Some of them are going to be serving individual customers on a direct peer-to-peer electricity wheeling program. As we see the South African market liberalizing, we're going to see a lot more of that kind of trading. And so it's going to become more and more important to be able to drive and drill down those forecasts from a demand perspective to the individual meter or individual consumer level. Now, zooming back up a little bit, speaking about South Africa, and I say Southern Africa here because South Africa's grid essentially serves most of the SADC region. And Southern Africa has a very massive grid. Currently, it's the 18th largest in the world. If you go back in time to the 1970s, it was actually the 6th largest in the world. And this is all to say, I mean, the folks on this call were speaking to the choir, but I think to a lot of folks that are not familiar with the African energy market, I use this slide a lot because it surprises people about how big the grid is actually in Southern Africa. I think people have a lot of misconceptions about Africa in general, and a lot of misconceptions about South Africa in particular around sort of the size and the complexity and the engineering expertise and the technical expertise that goes into the grid. But essentially, it's multiples times bigger in terms of transmission capacity than, say, Portugal, right? So it's same deal with Australia. So you have direct comparison or direct analogs with Western countries, and South Africa is much bigger. You also have 17 times more electricity generation than Kenya, which is also one of the largest generation hubs on the continent. You have over 33,000 kilometers of transmission and nearly 30 gigawatt hours produced per annum. I mean, this is a substantial grid. This is not unlike what we see on the graphs around electricity availability. This is not sort of a small time grid. This is a massive, massive market. We look at the total addressable market from the standpoint of electricity sales, and you're talking about anywhere from $1.5 to $3 billion USD. Now, with that to be said, one of the things that we've all experienced in South Africa or Southern Africa is that the grid is breaking, and demand exceeds supply by something around 17 gigawatts. From the South African standpoint in particular, over the last several years, we've seen 7,000 hours lost due to load shedding, as well as $13 billion USD in GDP lost to energy insecurity. Now, to its credit, the South African government is aggressively addressing this challenge. We've seen Electricity Minister Ramaphosa implement a number of policy changes over the last year, and particularly this year, some very dramatic ones, to help accelerate the pace at which private participation can be brought on board to help address this gap. Because I think there's full recognition across the board that the national utility Eskom is not in a position to address this substantial supply-demand gap. And furthermore, that the national government is not in a position to raise the capital that's necessary from global financial markets to address it on its own, and that it's heavily dependent, in fact, on private participation to do this. And so they've done things like the support of private wheeling, both peer-to-peer, as well as providing more wheeling platforms, or at least the beginning parts of wheeling platforms for energy trading companies, for private sellers to be able to participate and sell power that they're generating. South Africa's also lifted a cap on private power generation in terms of allowing companies to generate any amount without a license, starting in 2021 with a cap of 100 megawatts that you're able to build embedded generation-wise without having to have a license. And then lastly, the most dramatic piece happened this year, where there was the announcement of essentially the breakup of Eskom into generation, distribution, and transmission, and the establishment of a new national transmission company. In addition to a tender that they actually bid on, which we bid on, which was for a demand forecasting tool. So we can see that there are some pretty substantial changes that the South African government is trying to drive to bring in more private participation. And this is where we see a pretty tremendous opportunity for private generators, renewable asset developers, energy traders, smart metering companies, energy billing companies that are all private to participate in this market. And what we've seen also is, from the standpoint of generation, we've seen an explosive amount of growth. 6 gigawatts of solar installed just in South Africa since 2021, with a 32% compound annual growth rate, just in terms of the solar energy market, in terms of the total addressable market of solar electricity that's sold. What's also important, again, to the mission that we identified at the beginning, which is not just availability, but also affordability, is that solar and wind are the cheapest electrons in Africa, and we see that they are getting cheaper. Wind, we're probably not as bullish on, but certainly solar, given the solar irradiation that's available not just in South Africa, but I believe Namibia and Botswana in particular have the highest levels of solar irradiation in the world. So we see in this general geography a tremendous potential for solar generation. And that makes, the importance of real-time data even more valuable, because what that means is that there's a tremendous market opportunity for all the private players that are starting to come on board to be able to actually generate real revenue, real profit, and be able to actually then use that to catapult economic growth and economic development. So some of the important elements that we see, number one, and these kind of tie into the bullet points that we talked about earlier, enhanced decision making. So the ability to provide rapid response to market changes to help with optimized trading and dispatch. As I said before, currently South Africa has a very, I'll call it bulky time of use tariff strategy. I think, based on our conversations that we've had with Eskom, as well as with the Ministry of Energy and Electricity, that there is a real desire to move more towards a real-time pricing system. We're not there yet, but part of the reason why we're not there yet is simply that we don't have the data available to actually build a system for managing that kind of decision making. So that's one of the things that we're actually working on with government to try to build. The increased efficiency also helps with this. I mean, that's tied into the enhanced decision making, right? The better the data that we have, the more granular data that we have, the higher frequency that we're able to facilitate trading, the more efficiently we're going to be able to dispatch the electricity that is generated at price points that make sense for the generators. This also helps with improved forecast accuracy, which goes without saying. The better the data that we have, the more granular the data that we have, the better that we're able to actually generate forecasts. The issue that we're facing right now, and many of you can relate to this, is the fact that many clients, especially when they first get started, will either have no data at all. Let's say that they're a net new generator source, or they're a new meter or new customer account that gets set up. You're not going to have historical data. And you're typically not going to have a good way or a clean way of generating a model for that, because you're starting from zero. But in addition to that, you're also going to need to get data from a production perspective. And again, you have the same sort of challenges when you have a net new generation source that comes online. You just built this new solar facility. You don't have historical data. What are ways that you can actually get realistic, accurate data to build a model so you can start doing forecasting from day one? Risk mitigation. So again, you're not able to mitigate risk if you don't know the risk. The more data that you have, the more accurate data that you have, the more relevant data that you have at tight granularity allows you to then surface risks ahead of time, especially when you're able to then generate accurate forecasts. Then you're able to also identify risks. You're also able to start predicting patterns around things like load shedding, around things like usage spikes, around things like weather patterns doing damage to generating assets. And you're able to be much more proactive about either trade decision making or asset repositioning, asset fixing, etc. You're able to then optimize your resources when you're able to have this level of granularity in data, when you're able to manage risks, when you're able to actually forecast accurately, when you're able to more efficiently dispatch power. You're able to optimize the asset value that you have. And I think that's the biggest challenge that we see for asset owners across the continent, is that you're not always going to be running at 100% capacity, especially when you're relying on the sun being available. Even though the sun is very available in this part of the world, you're still going to deal with the fact that weather is unpredictable if you're simply sticking your thumb in the air. And so you're going to need to have tools that allow you to predict these elements, or at least have better ability to forecast or predict these elements in order to optimize the assets that you do have. And then on top of that, being able to leverage all of these 5 points then gives you a competitive advantage. When you have better data, when you're able to act faster, when you're able to utilize your resources at a greater degree, you're able to generate more revenue and more profit for your firm and for yourself, and you're able to then get a leg up on the competition. Now, we're not so concerned about that at this point, because at this point, the market is still very huge and extremely untapped. There are literally billions of dollars per year that are left on the table right now by generators because of the lack of connectivity around markets, the lack of ability to properly and fully distribute all the electricity that's generated, and so on. But these are all challenges that we are working with our customers to be able to resolve. Now, importantly, there's also the role of load and production forecasting when we talk about trading revenue. So it's looking at specifically the energy trading context. And the three kind of key areas that we look at here are assessing demand peaks, right? Really getting a sense and understanding where do we see the max demand within a given day. And this is where the individual meter forecasting becomes important. As I mentioned earlier, it's a lot easier of a task to predict demand at a bulk meter level. So when you look at a mini substation or a substation level where you're aggregating a number of different meters, right? And you're sort of aggregating the lumpiness or the spikiness of individual user demand, right? It's a lot easier to start predicting. But what's really important is actually to see those demand peaks on an individual level, because then you can start getting into more complex strategy like demand curtailment, which is, I guess, what the modern load shedding is being called right now. But then also you're able to do the opposite, which is you may have caps on how much your individual users or your generating sources are providing, but you're also then able to then shift that depending on what you're seeing from demand on individual levels. But the other piece is we also want to see, going back to the operational efficiency piece, we also want to see what are times where we can actually exceed the typical export caps. For example, if we notice that demand may be spiking in certain times, we may have to loosen up the caps that we have on how much our generators are able to then export to the grid, whether it's the local grid, whether it's the traders who are aggregating, et cetera. And this kind of ties into market responsiveness, right? Because at the end of the day, when you're able to predict demand peaks, you want to be able to then dispatch at a time that it makes sense to match those peaks. And a really good example of this is a client that we have in Nigeria, where they manage about 20 megawatts of solar generation capacity with battery attached to that. And their clients all are grid tied clients that are also intaking from them. So their clients are taking some from the solar plus battery combination and some from the grid. Now, if you're familiar with the Nigerian market, they also experience a tremendous amount of load shedding. Only unlike ESCOM, their national utility does not give them the courtesy of an advance warning. And so what will often happen is you'll just see sort of sudden power outages, and you just kind of know, okay, we're having load shedding right now. But the key part here is that for this client in Nigeria, they see massive demand spikes during load shedding, right? Which is natural because, if they have a solar plus battery, they still have power while the grid is out. And so all that demand shifts onto them. So that creates a problem for them, right? Because that means then that they basically sell out all the available power instantly because you see this massive demand surge that comes from load shedding. That also means, though, that they don't have an opportunity to adjust their price based on the demand that happens at that time. What being able to accurately forecast allows them to do, both from a production ability as well as a demand ability, is to be a bit more responsive. So if they can start forecasting when these sudden load shedding periods are going to happen, they can quickly adjust their pricing on a time of use basis to take advantage of the rapid peak in pricing. Now, we don't mean to say this in the standpoint of, we want to see people price gouging, but it's more because in those types of situations, you really do have to ration power, because what will happen invariably is that the largest demand centers are going to take up all of the electricity so that nobody else has access to any of the power. In reality, what you want to do to make sure that electricity is still available for everybody during this period of rapid demand spikes is essentially having load shifting, right? So having people shift some of that load that they would ordinarily have been taking up during that time to some other time of day, giving the grid opportunity to come back up, but then also giving our clients the opportunity to then generate enough electricity for all of their clients, albeit at a potentially lower amount of demand, simply because there's not enough power to satisfy everybody with just the solar and the battery that they have at their disposal. And then again, this speaks also to asset utilization, right? Because again, the name of the game for all of the generators and all the energy traders is to maximize the actual productive capacity of their assets. If you're not doing that, then you've essentially wasted a lot of CapEx building capacity that you're not actually taking advantage of. So before we talk sort of specifically about the solution, I want to kind of jump back up to the high level problem statement, right? So we talked about how from a market perspective, we're seeing this opportunity for massive amounts of private generation to come on board. We've also talked about the opportunity, which is the opportunity for using real-time data for getting accurate demand and production forecasts, is the ability to then be very granular at very low levels of latency, to be very responsive to shifts in demand and production, as well as we'll call them black swan type of things, load shedding, et cetera, right? That's all really important to be able to dispatch electricity at the right place, at the right time, at the right quantity, at the right price. But where we see the gap right now in the market is that we see a lot of generation coming online. We're seeing a lot of allowance from governments to start engaging in very sophisticated types of energy trading setups. We're seeing the opportunity for things like virtual power plants to come into play. But what's missing right now, and the missing sort of middle piece, is actually in the distribution, is to connect all these generators and demand to provide information to both sides so that everybody can make intelligent, informed decisions from a trading marketplace perspective. It's really kind of a marketplace or market maker that needs to be put into place. And that's the role that we see ourselves playing. And that's why we developed the tooling that we did. So to dive into this a little bit more, there are, at a very high level, what Asoba has developed are demand and forecasting tools. So we have our own proprietary models, both for demand as well as production forecasting. These are AI models that are able to generate higher levels of accuracy than your standard data science models or your more traditional statistical models. And then we also have tooling for driving optimal dispatch decisions. So it's not just about the forecasting, but it's also then enabling the ability for autonomous decision-making within the grid. And this is important because as soon as you open the door for peer-to-peer trading and you create that need to manage those trades, right, you start creating a situation where humans are no longer able to make those kinds of decisions. The closer that you move to real-time trading, right, the less and less able humans sitting in a network operations room can actually keep up with the volume. And we see this in Europe, for example, where, again, it's no longer humans sitting in an operating room making dispatch decisions on 1 hour intervals for 6 power plants, right? We're talking about autonomous operators that are making decisions on behalf of tens of thousands of individual mini power plants, which is essentially what a solar array sitting on someone's roof is. It's a mini power plant, right? So you're trying to make autonomous decisions, trading decisions at very tight time intervals for tens of thousands of different individual assets. Again, that's impossible for a human to make. So you do need to have some form of autonomous decision making to be able to run that. So diving into the features a little bit more, and maybe we talk more about this from the standpoint of benefits, right? The benefit of this kind of system, number one, is around enhanced data accuracy. So we provide very precise and consistent data, right? I think this is the consistent data, and the consistent data formatting is also really important because, again, different utility companies and different inverters, different types of assets are going to provide data in different schemas and different structures. And so we provide a system that essentially creates a unified semantic layer that then pre-processes everything and translates it into the same language. We feed that into the model. Then we're able to generate outputs no matter what the manufacturer of the smart meter or the smart inverter is. And this allows us, because we're able to then unify this data and create sort of a common data platform, we're able to ensure more accurate billing. We're able to reduce revenue loss just due to, again, the lack of accurate data, right, by up to 20%. And then this also helps improve customer trust because, again, you're not making decisions based on this aggregated data where you're kind of sticking your thumb up in the air, but you're actually using real accurate data that's granular that you can actually share with your customer, and your customer can actually see at a very detailed level, if they so choose, what are the actual composite components of their electricity bill. Then second comes with real-time data monitoring. So again, real-time data collection and real-time data analysis allows for, again, a very tight level of market responsiveness. Being able to then make these real-time decisions really fast becomes really, really relevant in terms of a competitive advantage, but also in terms of, again, maximizing revenue opportunities, because sometimes demand spikes are going to happen, and it's only going to happen in a 30-minute window, for example. So you're able to then maximize your revenue for that 30 minutes instead of being stuck with these really overly broad trading windows that you have right now, which force you to basically lose money over multiple hours when demand might be spiking, and you might be being able to take advantage of that. And then lastly, again, and this is sort of the foundation of it, is the forecasting and the dispatch decisions. The forecasting, both from the demand perspective as well as from the production perspective, and then also, again, the dispatch decisions, the autonomous decision-making across the grid. So I mentioned a bit more about how we create this sort of semantic layer where we take, from a wide range of smart meters, a wide range of smart inverters, and we essentially convert that into a standard format that we then feed into our models. And so that allows us to integrate with SCADA systems as well as other types of control systems. And there are a number of different ways that we can integrate with that. And we can kind of talk a little bit more when we get into the demo around the different ways that some of our customers are doing it. But then also it kind of opens up possibilities for more things down the line. But functionally, the way that this operates is that we have a number of API endpoints that customers can send structured data to, where they can either send it in the form of a CSV, or they can integrate it within their systems, and it becomes more of a JSON process. And again, whether it's push versus pull, these are all configurations that can happen. When I say push versus pull, what I mean is whether the customer themselves sends data to our API, or the API actually pulls the different devices that are connected on a periodic basis and then pulls the data from those devices that they're polling to then run the analysis. Either way, though, we support very tight integration with your existing system. So again, this can be something as simple as leveraging our UI to be able to then just on an on-demand basis generate forecasts, all the way to writing your own code, or even working with us to write code for you to integrate within your existing systems. So some of our customers already have their own dashboards. They already have their own apps that they provide to their customers. And in that case, we are just a data input or a data hose that sort of fits into their existing technology and simply provides data for them. So again, in terms of how it works, this image just sort of provides like a little bit of a diagram in the context of behind the meter trading. So there are a couple of different ways that we have implemented and deployed this. One is energy as a service, where we take over grid operations entirely for a bulk meter owner. So an example would be a municipality that purchases electricity in bulk from ESCOM and then resells that power to their end customers within their municipality. So in those kinds of contexts, we can come in, take over billing, take over distribution, dispatch. And what we do then is we essentially will take any of their customers that have generation on their rooftop. So if they have solar, we're able to then match that solar power to other buyers within the municipality. So we're essentially able to facilitate peer-to-peer trading between different customers within this system. On top of that, we are then also, from a sort of more hands-off perspective, we're also able to then leverage the API to, again, just integrate directly with within our customer systems. And so again, this is much more hands-off, more DIY. Folks are simply able to then leverage our API documentation, build using Python or Node.js or whatever programming language they see fit, to be able to then just integrate the data pipelines essentially that we provide within their tools directly. And so just to kind of talk about an industry use case, not to necessarily name names, but just to kind of take maybe take a composite of one of our existing customers, is to look at the pain points that an energy trader will face. So this might be an energy trader that is operating potentially across borders, or operating within the SADC region. Some of the core pain points that they're going to face are going to be things like forecasting accuracy. In their case, they're particularly concerned around production forecasting. And so they want to look at specifically weather and how it impacts solar forecast. And from their standpoint, they're looking at penalties that they have to face. If they're on the hook for selling 30 megawatts or 30 megawatt hours, and they're only able to generate 10 megawatt hours, right, then they become subject to penalties. So being able to accurately forecast on a day ahead basis how much they expect to generate means that the kinds of contracts that they're going to commit to are going to be tied to what they're actually able to deliver to minimize those penalties. Secondly, there's the issue of data integration. So, these energy traders are going to have their own systems that they're using. They need data inputs into that system. And in particular, they're looking at weather and transmission data that they're going to need to help facilitate their trading. Third, from a balancing fees perspective, these energy traders are subject to penalties when their supply commitments are not met. And so it becomes, again, incredibly important for them to be able to have very accurate forecasts of the production that they're going to be able to provide. And then also that helps them expand. They need to be able to forecast not just in a specific location, but to be able to forecast in other areas that they want to be able to operate and be able to then project, if I was going to buy this particular generating asset, what kind of IRR might I expect given this type of forecasting over the next, say, year or over this next period? So again, these are core pain points right now that energy traders face. There aren't particularly good tools to address these problems right now, and so there's a lot of operational and financial inefficiency as a result. Now, by leveraging our API solution, however, we can address each of these 4 pain points. Now, the flexible forecasting allows for real-time forecasts to be generated, both on a scheduled basis. In other words, we look at forecasts for the day ahead, but then we also have the ability for on-demand forecasting. So the ability, if you're operating or trading on even tighter same-day type of markets, you're able to have very flexible forecasts that allows you to then get insights on an on-demand basis for a given generating site. We're able to then also customize historical data. So we're able to integrate your data for accurate asset-specific models. And so essentially what that means is that we're creating forecast models, individual forecast models for each generating asset, as opposed to relying on either generic statistical models or generic sort of heuristics that people typically use for different sizes. We're able to actually train a model that's specific to that individual asset. And that means that the output from that is specific to that asset. What also helps is that we're able to provide very rich feature sets and that feed into our AI model. So it's not just weather data or some level of historical data. Any features that are available that are collected, we're able to add that to the trained models. The more features that we are able to add, the more accurate the model can be. And that's the benefit of the AI approach, is that we don't see degradation of model quality or model universality when we add a tremendous amount of features. That's one of the issues that more traditional data science models tend to fall into. And then lastly, we leverage a low latency, very scalable infrastructure. We sit on top of AWS, and more specifically, we're part of their Compute for Climate Fellowship, so we have a tremendous amount of resource support directly from AWS to help us scale this out. What it also means is, from a security perspective, we have best-in-class security protocols and standard operating procedures to ensure, compliance with PAPIA, GDPR, and other very tight privacy laws that SCADA countries are subject to. And so now what we'll do is we'll jump into a bit of a demo. So I'll demo a couple of things, and I'm looking at our time right now, so 15 minutes. So what I'll do is take about 4 or 5 minutes for the demo, and I can also make some of this video available to people on the call as well. But just to kind of very quickly start, I'm going to start with our front-end application. And so just very quickly, just sharing that we have a front-end application here that allows end users to essentially either test on an on-demand basis, or just simply, if they want a one-off forecast, or they want to train a model on a one-off basis, they're able to input specific data and then see actual outputs. So for example, here, each customer will have their own unique API key. This is essentially your token that gives you access to our API, so that a random non-customer cannot make API calls. Each individual meter or each individual customer that you have as an energy trader or smart metering company, et cetera, is going to have their own unique ID. And this helps us in the backend system identify and build a model that's unique and specific to this particular customer or this particular meter. Then you also have the ability to select, and right now we have two specific device manufacturers on here. You have the ability to select what device manufacturer you're actually using, and this allows our API to determine how to pre-process the data to then get into that more generic format that we feed into our model to actually run the training. And then lastly, you're able to then select a CSV or other data set that has the schema of this particular device manufacturer that we will then ingest and then build an actual model or generate forecasts depending on which module is selected here. So right now we have selected model training. So we hit submit. We see first the response that the file is uploaded successfully. You'll get a message once the model training is actually complete. The model training will typically take anywhere from 15 minutes to 1 hour, and that depends on a lot of different factors. One, it depends on how granular and how tight we want the forecast model to be. I think the more granular we want it to be, the longer it's going to take to actually train the model. But in any case, you can see the model output and sort of the whole process of what's happening in the background within this, so you can actually follow minute by minute as things are happening. And again, we do the same thing for run inference, which is to generate the actual forecasts. We have a few other features, but we're going to save some of those other features for another webinar and on the front end app. But just kind of keep in mind that we do actually have some additional features around more analysis around forecasting. So doing actual studies of different regions within your service area, both from a demand perspective as well as a production perspective. There's the ability to actually do this similar kinds of things, but for dispatch. And then we also have documentation for the API as well within the application. So if you also want to do your own building, you actually have direct information via our documentation to actually do that. All right, so the other thing that I'm going to do very quickly, and this is about 2 minutes, is I'm going to run a recording that we have that actually just shows the model actually running. And this is from our co-founder, Rain, who is just kind of doing a walkthrough of what we're seeing here. So hopefully if I play this, everyone will be able to see this. All right, we'll see. We'll start from the beginning here.
So as you can see in the after training, so this is about inference. So everything gets saved in a specific bucket. And then here we've got some client IDs. If we click on one of the client IDs, we can see the data that was originally used to train the model, the forecasts that have been made and saved, which I'll show you in a second. But then the important part is the training output. So every time a model was trained, it'll go into one of these folders and your best models will be saved. The parameters that were used to normalize your data is saved. The data that was used to train the model is saved, et cetera, et cetera. So then for inference, we have the model calling or fetching the best performing model from this bucket. And you'll see here, so the latest model was found at this and downloaded, the weights were downloaded, the normalization parameters were downloaded, etc. And so then your nowcast data gets fed through the model, and then you end up with your final forecast for this specific example as generation load and generation solar and total load. And you can see that the forecast for the solar ends up being like starts when the sun is shining, peaks in the midday, and starts decreasing after that. Where in this example, the load is very constant because we're using a business's data, where the business is just always on. So yeah, this is how the inference part works. Again, the best model is fetched, or the latest model is fetched from the bucket, opened up, and the nowcast data is fed through that model. And then the forecasts end up being saved in the bucket as well. And then we can send this back to you.
Awesome. All right. So that concludes the sort of overall presentation. Like I said, I'll share the webinar presentation as well as the videos that were shared here with everybody on the call. But now I want to open things up to any questions that anybody on the call might have. And we do also have some questions that were written in as well. I'll pull some of those up as well. Okay, so one of the questions that was sent in ahead of time, how easily can Asoba's API integrate with our current trading systems? So as I kind of mentioned on the sort of earlier in the presentation, there are a couple of different ways that we can integrate. So one is through simple like a JSON or a Node.js, not JSON, a Python or Node.js sort of code. Let me actually, you know what? Let me just show you an example here. I'm going to share my screen for just a second. Sorry, I got a little tongue-tied here. So if you can see my screen again, create a little Python example, Python code example of how you would actually write out the API request and integrate it within your own code. And so this is meant to be a very simple starter. Obviously, there are more parameters. And again, based on the documentation, you can add additional features and parameters as you see fit. But essentially, it's quite simple to actually then integrate this within your existing application. So it's basically just providing the API key, ensuring that you have the correct base URL, identifying the actual endpoints. You know, you may want to use a .env file instead of writing the API key direct within your app. But essentially, you have the connection sort of components. You have the payload. So what are you actually sending in? Again, you can throw in a CSV, could be a JSON format, and then you have the response formatting. So being able to then pull in what the actual response information is to then display as you want to see fit within your application. Let's see, what are some of the questions that we have? Another question is, how frequently does the API update its forecasts? So this is an interesting one. So we can actually set this in a number of different ways. For our energy as a service type of clients, we typically run both model training as well as forecasting on a scheduled basis. So if we were to say do an hourly day ahead type of forecast, we would typically run the forecasting model for each of the individual meters that we're forecasting for once a day, let's say at 11 p.m. Right, and then we generate it for the next 24 hours, hour ahead. At the same time, end users can also call the API on an on-demand basis. So basically, whenever you want to, you can actually call that. Now, from the standpoint of updating the forecast, so I think there's the actual generating the forecast and generating a new forecast, and there's also the process of retraining a model. So in other words, we may start with a particular model that we trained based on historical data that's shared, but then over time, because we're connected to the meter and we're getting real-time data, we can then continually add more data elements on top. And that allows us to then retrain that model. And typically for our energy as a service customers, we do that on a once a week basis. But again, with the use of the on-demand API, you can essentially do that whenever you see fit. Just keep in mind that there are compute costs associated with continuously running these kinds of models like constantly, and that the way that we structure it or schedule it sort of represents sort of the cost optimal way on the back end while still providing the level of accuracy that's needed. Let's see. In terms of implementation, how long does it typically take to implement a Asoba API? So this is going to be dependent on. Oh, I see, Calvin, you raised your hand. You want to go ahead and ask your question, then I can jump on that other question next.
Thanks, guys. although I was gonna allow you to finish before I come in.
Okay, I'll just quickly finish that up then. So in terms of length of time to implement it, it kind of depends on the complexity of the use case. So we have some use cases where our customer essentially already has all of the data that they want, and they're simply looking for more accurate forecasting. In which case, implementation is fairly quick. We can do essentially a quick comparison. So we say, give us 1 or 2 meters and the historical data for those meters, and then we will generate forecasts for you. And then we'll compare that to what you're currently doing. And if there's an accuracy improvement, then we can move forward. But again, implementation in that case is very simple. Then we also have some other customers who want to integrate this data into their existing applications, but they need some development support for that. Or we have some other customers who have data, but it's not complete data. They have very patchy data, or their customers are coming to them with aggregated like monthly billing data, and they don't actually have granular hourly data. So then we'll have to do a process that's called interpolation. So essentially we create synthetic data sets that are based on that aggregated data. So basically explodes out that aggregated data and creates sort of a synthetic load curve that's based on either a digital twin, some sort of transfer learning process, or using a composite that's similar to the customer that's in question. That will typically take a bit longer because there's some custom development work that has to go into that. So there's a bit of a range, but it really just comes down to how much data and how granular the data that you do have is available. All right, so on to you, Calvin.
Thanks. And just some context, I'm dialing in with an investor heart in mind. I'm representing Renew Capital, just to appreciate why I'm asking, right? I just want to understand more about what you've done so far from a traction perspective, the clients you've serviced, and if you're able to share more insights on that, maybe in terms of how much revenue you've generated.
Yeah, sure. So we've worked with 7 municipalities in South Africa. We're also working with municipalities in Cameroon. So currently we have 1 that we're onboarding right now, and an additional 4 that we have that are going to come online at some point next year. We're in the contracting process with the national utility in Mali, which is sort of quite a bit of a different use case than most of these others. I think they're sort of looking more at the operational efficiency side of things almost exclusively. And that's sort of on the energy as a service model that I kind of described. For the API model, we launched that at the beginning of this month. Right now, we have 14 customers that have signed up. We're targeting another 20 by the end of the calendar year, just to kind of give you a sense of what the scale for that is going to be. This year, we generated about 20K USD in revenue. That's almost entirely from the energy as a service model. Next year, based on what we have under contract, we're looking at about a 500K annual revenue that we're expecting, both between the API product as well as the energy as a service.
Got it. Thank you for that. Just to follow up quickly, I see on your Crunchbase, it tells me you've done your pre-seed already. So, and congratulations for that. Do you intend on doing your seed round? So
yeah, I mean, so I think we didn't update Crunchbase ourselves. So we haven't quite closed our pre-seed yet. We're actually still there's still a few term sheets that are coming in. We still have a few more soft commits. We're raising another 500K on top of what we've raised so far. We anticipate getting the rest of our term sheets or soft commits by the end of November of this year.
Interesting. If you're interested, happy to have a follow-up conversation sometime tomorrow or later today.
Okay, perfect. Yeah, I have your information and we'll get in touch.
Awesome. Thank you.
All right, I see one question from Brian. For a C&I prosumer, how do you balance the individual site need for energy power with the possibility of exporting to the grid? And how do you go about training the model for a fairly complex site with PV plus battery storage plus genset plus grid on a time of use tariff scheme? Okay, so for the first part of the question, how do you balance the individual site need with the possibility of exporting to the grid? So that we delegate that decision making to our end customer, right? I think what we see ourselves is the tool, and the customer provides the guidance in terms of how they want to use the tool. So from the context of the first question, the individual site needs versus exporting to the grid, that's just down to the financial concerns of the end customer. So for example, for the case of a municipality, if they're trying to maximize their own revenue, and I think that's actually a common thing in South Africa, right, is that so many municipalities are in arrears with Eskom. So their primary goal is actually to minimize how much they purchase from Eskom. And which means that their priority is actually more about recirculating the solar that's generated in their municipality to other customers so that they can reduce how much they bulk purchase from Eskom. So that's one example, but again, we don't make that determination. Our customer makes that determination, and we're simply the tools that they use to make that decision making and execute that plan at the utmost efficiency. From the standpoint of training the model for a fairly complex site, now keep in mind that we do our model training on an individual meter or individual inverter basis, which means that all four of those elements, well, not the grid part, but the other three elements in that complex site that you mentioned, we're individually forecasting for all of those already, and then simply using the dispatch optimization to then match based on the policy that the customer wants to optimize on what the most efficient matching of movement of electrons is. So sort of again, at a high level, we provide the tools, but at the end of the day, what decisions need to be made and what needs to be optimized for is the decision of the end customer, and we simply configure to meet that need. All right, we are at the hour. So I appreciate everybody for attending. And like I said, we'll make the materials available to everybody on the call. We can follow up with those that have interest in having further follow-up discussions. And like I said, catch us next month. We're going to be doing these once a month. And so we'll advertise the date on our socials. We'll have follow-up emails as well for those that have signed up, so you get on our newsletter. But yeah, I appreciate everyone for joining, and hopefully everyone has a happy and fun and safe Halloween.
Action guy.